Today, in under 20 minutes, I will provide what you need to know if you want to invest in Tesla. Trading near 461 per share, I currently have a hold rating on Tesla stock, but there are several key factors that have a major impact on this thesis that I'll go deeper on. I will give you the positives and negatives from the 3Q25 results, a breakdown of the three financial statements and my Wall Street valuation model, what other analysts on Wall Street say about Tesla, and my conclusion on Tesla's future and what you should do. So why should you listen to me? My name's Ken Freeman. I'm a CFA charter holder. I'm also a professor of finance and economics. I have 20 years of Wall Street experience, and I'm the guy that investment banks like JP Morgan and asset managers like BlackRock hire to train their financial analysts on Wall Street. In my research, I discovered 7 things that got me very excited and 7 red flags to watch out for with Tesla. If you're enjoying this, please smash that like button. Tesla had record revenues in 3Q25, but fell short on profit estimates. Cybercab, Tesla Semi, and Megapack 3 are on schedule for volume production starting in 2026. And Tesla is making the necessary investments to drive incredible value across transport, energy, and robotics. Let's cover the red flags first. Costs are ramping while profits stall. Tesla is spending big on AI and R&D, but the payoff isn't showing yet.
Well, Tesla's in a transformative stage at this point in time. We're leaning in very heavily to the AI space in terms of both the vehicles, in terms of FSD, but also in terms of Optimus and the robots, as you can see here in New York today.
Operating margin is getting squeezed. Record deliveries don't mean much if they earn less profit per sale.
Q3 adjusted EPS looks like it's clocking in at 50 cents. That's versus consensus at 54 cents.
12,963 vehicles could lose drive power. That's a public relations nightmare. Hardware fixes mean real costs, not just a software update. A jury hit Tesla with damages of $129 million compensatory and $200 million punitive. On top of that, R&D jumped 57% as Tesla invests in humanoid robots and driverless cars. With R&D and AI investments hitting profits, any unexpected bad news really stings.
Musk will lean into, sort of brighter, shinier objects like humanoid robots and driverless cars, but those are products also that Tesla has yet to really commercialize in any fashion.
Over $400 million in tariffs plus lower credits is a double whammy. Costs rising faster than sales, that's how profits disappear.
Once we see EV tax credits go away in the U.S., that Tesla could be in for, in his words, a few rough quarters. And I think that's, sort of something that's reinforced by what we heard from GM yesterday and in the lead up to their earnings, that this is a case of just a sort of widely held view that EV uptake is going to slow pretty dramatically in the U.S. without these incentives.
Top engineers and leaders are leaving, which raises doubts about execution on Tesla's bold bets. In the AI arms race, retaining top talent is critical to keep progress moving forward.
We are a team.
Tesla leadership is putting all the pressure on shareholders. Sounds like the board is worried. Musk is the brainchild of Tesla, and if he walks, the investment thesis changes dramatically.
Shareholders need to vote in favor of this compensation plan to compensate Elon Musk and to make sure that he remains the CEO of the company.
Here's what got me really excited. Tesla has over $41 billion in cash. That's a safety net and growth fund rolled into one. They can finance AI, factories, and energy projects without borrowing a dime.
They are well funded and have liquidity, $41 billion in cash, up $4 billion sequentially. Everything that we're talking about today is accurate, that the investment case for Tesla is all about on what's to come. And the reality is that in order for that future to become a reality, you have to have a lot of money to do that.
Nearly $4 billion of pure cash generation. Even with cost pressures, Tesla is a cash cow. That's fuel for expansion, including AI, self-driving cars, and robotics.
That $41 billion compares to GM and Ford, each have about $23 billion. So that was one of my takeaways. That they've got a lot of money to see this forward.
3 times power density, plus 1,200 kilowatts of semi-charging. That's a hardware advantage that rivals can't match. 3,500 new stalls in 1 quarter deepens Tesla's infrastructure lead.
What Tesla has done really effectively is they've produced vehicles at a very low cost relative. They've done that on their own without really, over time, government support. And they have a feature set that's incredibly effective, and they've shown that they're able to compete in China against these incredible companies in that country.
Demand is still strong. Tesla hit 497,000 deliveries in one quarter. Big volume gives leverage for scale, even if margins are under pressure.
This is a company that is coming off a really solid quarter of EV sales. They're the most that they've had in a quarter ever.
Tesla is beating estimates in overseas markets, giving growth options beyond the US. More foreign income means less dependency on one market and more runway for expansion.
If you recall, the first 2 quarters of the year were pretty bad for Tesla, and there was a rush in Q3 to buy EVs in the US, but it wasn't only the US. I mean, they released some new vehicles in China that did incredibly well.
Lower prices via tax credits equals a demand pop that helps fill factories. That could help offset the margin pain by boosting volume quickly.
So that more affordable vehicle is already out. It's the Model Y and Model 3. Based on some language in the deck.
This is what everyone is missing. After recent dips, Tesla posted 12% year-over-year revenue growth in Q3 2025, proof that demand is still solid. Top line bouncing back means future profits will be increasing.
So you have to look at it where the growth is going to be, and right now it's trading at about a 13 revenue multiple. So compare that. Usually it's been kind of around where Apple's at. Apple's at a 9 revenue multiple, and so it's an order of magnitude ahead of where that's at. And so the simple takeaway is that if you use like traditional ways of thinking about stock and evaluation, this is overvalued. If you take a perspective that they're going to have a breakout and the rest of the companies, I actually think that the GM news today was affirming of Tesla's lead on autonomy. But if you take that, you can have multiple years of high growth, 30, 40% growth.
When it comes to any stock, I let the numbers tell the story, and that involves looking at the company's financial statements. Would you buy a house without knowing the size, location, dimensions, or condition?
Nope.
That is exactly what you're doing when you buy a stock without understanding the 3 financial statements. If you want to see how I train the world's top financial analysts on Wall Street, check out my school community, Win Like Wall Street. Just scan the QR code on the screen. The balance sheet shows us how the business is funded. If assets grow faster than liabilities, equity increases, and we win. There's something really cool about Tesla's debt that I can't wait to show you. Tesla has over $37 billion of cash and investments at year end, and almost $43 billion at the end of 3Q25. And they are net cash, meaning cash is greater than debt by over $35 billion. This gives the company a pile of cash to invest in the future, including self-driving cars, robo-taxis, and humanoid robots. Debt is currently $7.7 billion. It's up $500 million since year end, but $3.5 billion is in asset-backed notes. Here's what's cool about that. They took their leases and issued debt against those leases so they could get the money back and have it fully supported by the cash flows from the leases instead of their core business. Retained earnings grew 116% in 2023 and 26% in 2024 to over $35 billion. Tesla and Amazon are the only Mag 7 stocks to not pay a dividend, which gives more money to reinvest in the company for the long term. So what's the takeaway? Tesla has tons of cash, its debt is under control, and it's substantially growing retained earnings. The income statement shows us if the company is generating profits. We want to see revenues grow faster than expenses, which will grow profits. The way to determine how effective a company is at generating profit is via margin. Revenues minus expenses equals income, income over revenues equals margin. If a company has higher revenues and lower expenses, it will have higher margins. If revenues grow faster than expenses, margins will get bigger or expand, which is what we want to see. Revenue growth has turned back to positive year over year in 3Q25. This growth is due to an increase in vehicle deliveries, growth in energy generation and storage, and growth in services. The growth in energy and services are especially important as Tesla develops self-driving cars and humanoid robots as future revenue sources. Gross and net margins experienced slight contraction in 3Q25, mainly due to an increase in operating expenses and higher average cost per vehicle. While quarterly net income has been increasing through the first 3 quarters of 2025, last 12 months net income has been decreasing through the first 3 quarters of 2025. Be prepared for some volatility in profits as the focus on hardware increases, but the company is confident that hardware profits will be followed by software profits, and the investments being made now should drive value for Tesla across transport, energy, and robotics. So what's the takeaway? Growth is starting to recover, and short-term increases in expenses should be followed by long-term increases in profits as Tesla focuses on becoming a leader in AI self-driving cars and robotics. The cash flow statement tells us where the cash is generated by the company, and there are 3 buckets. Operating, which is the cash the company generates internally, investing, which is the cash demanded for long-term growth, financing, which is the cash the company generates externally. When we add these together, we get the net change in cash. We want to see companies generating cash making this positive, not losing cash, which would make this negative. Operating cash flow is positive and has grown rapidly over the last 5 years, but it's leveled off in the last couple of years. Operating cash flow has nearly tripled through the first 3 quarters of 2025, going from 2.2 to 6.2 billion. This has primarily been driven by the growing net income that the company is generating. Trailing 12 months free cash flow is the highest it's been since 2022. This is a combo of solid operating cash flow and lower CapEx. Most of the investment in AI, full self-driving, and robotics in 3Q25 was captured and expensed in R&D. From 2022 to 2024, Tesla generated $40.7 billion in proceeds from its invested cash. Year to date, that number is over $22 billion. This is something that we have seen with other Mag 7 companies, and it's a sign that Tesla has excess cash to invest and generate passive income. Also, Tesla has not needed to issue equity over the last 4 years. There is no dividend and no share repurchases, so Tesla is self-sustaining and plowing its money back into the company for future growth. So what's the takeaway? Tesla is using the returns generated from its cash to invest in AI innovation, self-driving cars, and humanoid robots. So what do I think about Tesla and what should you do? I'll get into that, but first, let's go through my valuation. On Wall Street, we build a discounted cash flow model to measure the intrinsic value of companies. Because companies generate cash flow and we projected the 3 financial statements, we could take these future cash flows, discount them back to today to get a current intrinsic value for the company. We cannot do this type of valuation with crypto, baseball cards, or art because they have no cash flows. As you can see on the left, we take specific line items that we projected from the 3 financial statements. We use these line items to calculate free cash flow to the firm, or FCFF. To this, we add a terminal value, which is the value from the end of the model out to infinity, because the company does not stop operating when our model ends in 5 years. We discount these cash flows back to today to get the total enterprise value. To get to equity value, we strip out the debt, we add the cash, we strip out non-controlling interest, we add associate investments. We get an intrinsic equity value of about $1.35 billion. We divide by the current shares outstanding. We get an implied share price of $405.40 compared to the current close of $461.51. That's a 13.8% premium, which is a sell rating. Now, do not buy at these levels if you do not own Tesla. If you're a current owner, though, I would say this is a hold rating. You might want to consider trimming to a lower weight, but I'm going to get into a lot of detail as to what I'm doing as a Tesla owner in a little bit. I'll give you my thoughts on how to play Tesla later in the video. So what does Wall Street have to say about Tesla? Let's cover that next. Wall Street has a wide range for Tesla, and the general consensus is that it is a hold rather than a sell or a buy. Goldman Sachs maintained a neutral rating and lowered its price target to 400 from 425. They acknowledge long-term AI and robotics optionality, but keep a more measured base case given near-term fundamentals and margin mix. Cantor Fitzgerald lifted its price target to 510 after highlighting 2026 volume ramps for Cybercab, Semi, and Megapack 3, and near-term Optimus production, arguing these AI, robotics, and energy milestones extend Tesla's growth runway. Wedbush reiterated its bullish stance and price target of 600 on the view that Tesla's AI and autonomy optionality remains the core upside driver. CapIQ gives me a sense of how other analysts on Wall Street view the company. 41 analysts cover Tesla on Wall Street. The range is from a low of 120, which is a 74% decrease, to a high of 600, which is a 30% increase. The median is 420, which is a 9% decrease. The overall rating on a scale of 1 to 5 is 2.62, which is a hold rating.
You should seek the advice of an investment professional always. I do not know your individual financial situation. This content is meant to educate and is not investment advice.
That being said, I do own a position in Tesla. I am a big believer in the company, and it is currently the largest position in my portfolio at a weight of 10.6%. If you decide to buy Tesla, you need to get in at a good entry point, which I'll reveal shortly. Energy storage deployments jumped 81% year over year, Tesla's next growth engine. Energy gross profit hit $1.1 billion, diversifying away from EVs.
The energy storage story is a massive pickup over 2Q. I think they were $2.4 billion. They just printed $3.4 billion. I mean, it's 12, 13% of the revenue base. It's not insignificant, and it's also one of these stories that is part of the entire mosaic.
Unlike typical automakers that redesign every few years, Tesla cuts heavy CapEx by iterating via software. That approach could mean lower costs and faster updates, advantages in a fast-moving EV market.
He's spending time on many different areas. On the earnings call, he even talked about the AI chips that he's been working on and the team are working on. Obviously, the software, we do have a few other vehicles coming out, so he spends time on that. He's spending time on everything across the board.
Tesla's not just building cars, it's training robots and driverless systems that could redefine global labor and transport. Wedbush's Dan Ives calls it Tesla's AI revolution, betting long-term on autonomy and humanoid robots as trillion-dollar markets.
But the biggest thing is going to be on the consumer. I mean, it's our view, and we're not talking 10 years now, we're talking like 2-3 years, that like it's going to become commonplace to have robots in houses. And again, that is my view. Like, it will be doing the wash. It could be taking the dog out. In other words, like, it's going to be doing functions that in a house, these are going to become more and more commonplace over the next decade. And Tesla's going to own that robotics vision as well as the autonomous vision. That's why you're paying Musk $1 trillion in terms of, if he hits all the goals. That's why Musk is the most important asset for Tesla. It's the future, and what I view as a physical AI play, there's NVIDIA, and then there's Tesla.
Tesla hit a 52-week low of 214.25 in early April, and it's up over 115% since then. Tesla is a core foundational investment that you must hold for the long term to realize its full potential. My model shows a value of $405.40, which is a 13.8% premium at current levels. On Wall Street, we buy with a margin of safety of at least 20%. So Tesla is a hold at current levels for owners, unless you have a large position, which you could consider trimming.
Great advice.
If you don't own Tesla, I would be looking to buy below $340 to provide the 20% margin of safety. If you choose to invest in Tesla, do not invest simply for the electric vehicles, because that is not where the long-term value is. You must believe in the Tesla ecosystem, which includes humanoid robots, megapack batteries, robotaxis, and self-driving cars. If you like this and want to see another in-depth stock valuation, check out my Adobe video here or my Constellation Brands video here. And if you found this valuable, please share this with someone who you think would enjoy this. As always, be relentless.